The banking crisis isn't over, but there's a way to handle troubled banks. Today, First Citizens Bank took over the failed Silver Valley Bank's branches, loans, and deposits. They're buying $72 billion in loans at a $16.5 billion discount. The $90 billion SBV securities will remain in receivership. This deal works because the government already owns Silicon Valley Bank after taking the stock to zero. This can only happen in receivership after a bank has already failed, as it eliminates a lot of risk for the buyer. Our system isn't ready for bank failures, and there's no guarantee for support. First Republic must fail before a good deal is possible, unless the FDIC indemnifies the buyer. The government has a plan for bank runs: close the bank, zero out bonds and common stock, and find a buyer. First Citizens Bank's stock jumped 53% with this deal, and other banks are assessing potential profits in similar situations. This can create a virtuous circle with increased stock value and incoming money. A bank collapse has a similar impact to a rate hike from the Fed. First Republic is not like Silicon Valley Bank, which fell apart in 48 hours due to a concentrated deposit base of large venture capital firms. First Republic's deposit base could be more intrepid. Businesses making decisions don't want to risk their money. The struggling regional bank is not protected above $250,000 with FDIC's insurance, and many of First Republic's customers are very rich with more money than coverage. First Republic can borrow from the Fed at decent rates and determine how many U.S. deposits are protected by the $250,000 limit. The government may allow it to fill the gap. The velocity of the run on the banking system has slowed since last Wednesday when Janet Yellen told Congress there was no master plan to save the banks. Regulators are likely working on a plan to inspire confidence and prevent depositors from fleeing regional banks.